I don't know about you folks, but I have been looking forward to this discussion because I want to dig into the details of both the discussion we had with Ali Wolf and Sean Dobson. In order to do that, we have the founder of Resi Club, Mr. Lance Lambert. How you doing, sir?
Doing good. Thank you for having me on. Housing, housing, housing. Always a lot going on. And so over the weekend, I published a piece, my interview with Sean Dobson. He's the CEO of Amherst. And Amherst owns 44,000 single family homes across the country. Sean is a little bit famous because in '05, he realized there was going to be a crash in house prices and started making strategic bets against the housing market in what later became known as the Big Short. And so his 37-year career it started out in mortgages and mortgage-backed securities. And it's only been the last 12 that he said that he's been buying real assets, which is homes. And so actually his story kind of coincides a little bit with your bets against housing when you pulled out. And then when you really started diving in, and so they were kind of diving in 2012 and on, or 2011 and on, buying up these homes. And so in the interview, I really wanted to know from Sean, somebody who is one, very frank, and he isn't afraid to be a contrarian, what he thinks about the US housing market, where he thinks things are going, what does he think's going on. And he didn't disappoint, and he doesn't do very many of these interviews. And so I put this one into Resi Club Pro, which is the premium side of Resi Club, the 3 additional articles a week, and then access to my inventory and price tracker comes along with that. And what Dobson had said, and I think first it might be good to talk about what his business is. They buy homes one at a time through their own brokerage platform. So one at a time. I know isn't that somebody's whole thing?
Yeah, somebody does that. Yeah, one at a time. Yeah.
So not buying bulk, not taking up huge neighborhoods, finding deals one at a time and using their algorithm to do it. They have their own brokerage firm, their own robust data analytics to do the asset selection, market selection, and return forecasting. And then, their brokerage sources the homes, underwrites them. They have a construction management business, which is completely vertically integrated into their company, does all the renovations. And then they also have a national property management company that leases and provides resident services. So
yeah, real quick. And I just want to kind of make this connection, and why I really appreciated the Sean Dobson article is because it did feel a lot like one rental at a time, just at a totally different scale. What I saw in Sean Dobson was somebody who had the money and power and knowledge to invest in systems, analytics, to help find deals. This is what I tell everybody to do. Get a buy box, look at your buy box every day. Very quickly, you'll be able to identify a better than average deal. It's the same thing, just at a different scale. And then the fact that they also in the article, and sorry if I'm skipping ahead, it sounds like his model, right? Buy with a 6 cap, sell with a 4, because again, he's buying and selling. I thought that was very intriguing as well.
Yeah, and so that's the thing. It's not all accumulation. There is a lot of churn that occurs as they kind of push some of the inventory back into the market. And so when you hear about stories about like institutional buyers being net sellers, what it really means is a lot of them have continued to churn off homes at the same pace, but they've really kind of pulled back their buying a lot because the math makes a little less sense right now for them.
Of course.
And so it's not like they're out there throwing homes out at a crazy pace than before. It's the natural churn off of the homes they would have sold anyway occurring. They're just not buying as many. So it becomes net sellers. And what he says is, the number one factor that makes this market unique is just the dearth of inventory. This is the very low inventory market. And during the pandemic, new listing volume was pretty healthy, he said. There was plenty of homes coming for sale, but the velocity at which they were selling was so fast, it was drawing down the inventory. Now he says it's completely flipped. The pace of the drawdown of inventory on a percentage basis is healthy, but there's just no one selling. The new listing volume has crashed. So now inventory is getting drawn down by the lack of supply instead of excess demand. Spot on.
Yeah.
Very well summarized. He said the lockup effect has really dried up inventory. Higher rates are making it more difficult for people to qualify. When you have a switch cost now that is $1,000 per month to replace the same mortgage balance you have at a higher rate, it is incredibly high barrier for people to move. People don't want to trade in their monthly mortgage. It's going
Yeah,
on a lot.
I loved. I mean, you and I talked about this 6 to 9 months ago about your personal situation, but I loved how he kind of pointed it out. Like for likes, $1,000 switching cost. You're
Yeah.
not making that trade. You're just not. It's just not happening.
He said there's a supply issue and just a lack of supply, and it's going to drift listings lower over time. And right there, I pressed him a bit and I said, do you believe that new listings haven't bottomed? Because the consensus right now is that new listings have bottomed and that it will now be a slow grind up.
Yeah.
And what he said is, we have one of the best prepayment models in the world, and a function is forecasting housing turnover. And turnover is driven by a bunch of things. It's switch cost, it's equity in the home, it's tenure of the home.
Yep.
So we have a pretty good idea of what turnover is going to be. If housing turnover in the past was running at 6 or 7%, it's probably going to run at half that now. That's just people selling for natural causes, death, divorce. But I don't think this new listings is close to bottoming out, he said.
That turnover stat, I mentioned it the very next day on my daily financial news, giving Resi Club props for that. That should shake people to their core. If we go from 7% to 3%, yes, people will sell, death, divorce, job, yes. But if we cut turnover in half for any length of time, he's right. Inventory's going lower.
I asked him what he thinks U.S. home prices, which are facing the headwind of deteriorated affordability, where they're going. And he said, I'd say whatever our forecast is, it has a higher range of error than it normally would, right? Just at a point in the housing market to where I don't think anyone really knows, to tell you the truth. But he said we can't ignore that inventory remains down 40% since pre-pandemic levels. And if strained affordability is the headwind, then the lack of supply is the tailwind. And then he goes on to say, it is one of these markets where the fundamentals, and he's talking about things like price to rent ratios and affordability, aren't great, but the technicals are unbelievable. And I asked him, what are the technicals? He says the dearth of supply and the fact it's very expensive to build single family housing stock. So the fact that you can't build something and price it lower than the market, and the fact that there's not much for sale on the market, is the tailwind for the market. And so what Sean said there, and my recorder died at this part, or else I would have the quotes from it, is I then asked him, okay, inventory is so tight, what happens if mortgage rates go down a lot? And what he said is price growth today is driven by technicals. It's driven by the fact that there is just no listings on the market, essentially. I'm exaggerating, but there's not the listings on the market, and then the new construction bit. That's the technical supporting it. The fundamentals are hurting price growth, but the technicals are just pushing it forward because they're overpowering it. But he said if mortgage rates move down a lot, the fundamentals on affordability would improve. But what he thinks is, he thinks the price growth wouldn't probably move too much. It could stay kind of flat. And instead of being supported by the technicals, which are strained pushing it, they could just be the affordability puts it more normalized, is what he's saying. Now, we're not, now in that hypothetical, we weren't talking about like 4% rates.
Right.
I don't necessarily know. And again, he's saying there's a lot of uncertainty to it.
Yeah.
His idea is right now, technicals are pushing growth forward. But if mortgage rates improved, affordability would. So I thought that was interesting to get into with him. And then we got into what's going on with the institutional side. And John Burns put out the latest number, which shows that in the latest quarter, 0.4% of homes, 1 in 25, were purchased by institutional firms.
Okay.
In Q2 2022, it was 2.4%.
No, no, with 1 in 2, so 1 in 25 is 4%. Do I have
Now
that
it's
right?
1 in 250.
250.
It
One
was
in 250.
142.
Got it. Okay.
So they've
One in
gone
250.
way down. And
Yep.
really, the pullback is greater than that number makes it appear because the total size of transaction volumes has
Right.
been
Fell
crushed.
as well. Yeah, yeah,
Yes.
yeah,
So
yeah.
they're really pulled back right now. And
Shocking. Rates matter? Is that what you're telling me, Lance? Rates matter?
Rates matter. And it comes down to the math for them.
Yeah. Of
And
course.
these guys are chasing yields. And
Mhm.
and here's what Sean said: the pace of institutional investment is way down for sure among the operators. We're all deploying single asset capital way slower. A part of that is just the fact that investment requirements have gone up and home prices have gone up. Rents create the equilibrium there, and rents have clearly not kept up with the increased cost of housing from purchasing. It might take a while for those two things to get back into alignment. You are paying more for the home and more for all the things that go into the home. And he's talking about renovations. And so he says the bulk of what we do in single family home business is pretty dramatic renovations. We're changing air conditionings, foundation repairs, flooring, complete new kitchens and bathrooms, all that fun stuff. There has been a really tight labor market to get those projects done at all. And of course, the prices is up 20, 25, 30% for construction labor, and the home prices are up. So your two main costs are the renovation cost and the raw asset, which means home prices. And the thing you're creating, the yields, is worth less than it used to be because the rents haven't moved.
Mhm. Yep.
And this is where things get interesting. So the last time U.S. home prices and rents were this far detached, single family house prices crashed in 2008. This time around, Sean believes the single family rents will increase, which will help to bridge the gap between the acquisition economics for institutional landlords. So the gap between rents and prices are so wide. Last time prices came down to rents. Now rents continue to move up, but prices did a lot of the work. This time around, he thinks it's going to be the rents moving up, and he thinks there's a tailwind for rents on the single family side. And even through this, even as we see a lot of these multifamily rents soften, and I'll have a story out today, single family rents, they're not ripping like they were before, but they're still moving up.
Oh,
Um,
absolutely. Absolutely.
and so, at least nationally. And he said he also acknowledged that institutional landlords are facing more of a challenging environment when it comes to raising capital. And this is interesting too. He says it's been tricky. I would say the last 8 or 9 months, it's been in stops and starts, fits and starts. Investors in the commercial real estate are very distracted with their office portfolios at the moment. It's residential real estate and logistics real estate that are doing well. And I think he means warehouses.
Warehouses, yeah.
And pretty much what he's saying, it sounds like, is just the capital environment has shifted. And a lot of the capital environment is also worried about the commercial real estate side.
Well, yeah, the commercial real estate market, there's things going on called capital calls. There's cash in refis. There's a lot of pain there. There's probably investor capital, aka LPs, that are trying to make some pretty tough choices.
Yeah.
And they have some work to do on that side. So that makes sense.
I thought it was interesting also, and this diverts from this, but the Invitation Homes, their earnings call, which I listened to the whole thing. What he said is the CEO there, I think it's Dallas Tanner, if that's right.
I think so.
He said that they're always looking for opportunities, and one kind of fell. I'm paraphrasing. One fell into their lap last quarter. And it sounded like what he was saying is that, some of the distress in the commercial real estate side could create some opportunities for them in the single family acquisition. And so
Well,
get a
yeah.
big portfolio from Starwood. And yeah, and
Well, let me put a point on that, because again, we talked about it on this channel a couple of times. The guy I call Billionaire Barry, it was not very liquid when Jerome Powell came out in Jackson Hole over a year ago and said, I'm gonna raise rates and make it painful. He had to shut down his mortgage business, bankrupt. He had to stop distributions. He had this portfolio of single family homes that were performing, but he needed cash. So sometimes when you sell something to raise cash, you sell the best asset. He shopped it around to all the big players. He wanted to sell it to one person. He didn't want to list 1,850 homes one at a time. He needed cash today. And Invitation Home paid the most money. So
Yep.
Invitation Homes got a deal. He got some cash. Win-win transaction. All this talk about big portfolios going on the MLS one at a time is such a joke.
They won't make it there. They won't make it
No,
there.
they will not make it there.
Essentially, what Invitation Homes said in the earnings call is they're still looking for opportunities.
Yeah.
So if places like Invitation Homes are in a good fiscal position and their assets are only single family homes, they will be the ones catching the single family homes that fall out of those multi portfolios.
Exactly. You got a commercial lender who's got a couple office buildings, and they also have a few hundred homes that they picked up over time. Here, Invitation Homes, take it. Give us 85 cents on the dollar, but cut me a check tomorrow. We're good.
Yeah. And so that's where we are in the real estate cycle. And that's what he said, is that we're in a unique part of the real estate cycle. That was actually his phrasing of it when he got into it.
I love it. I love it. Well, you know what? I'd be remiss if we didn't flip over to your article in the free version of Resi Club that I think came out yesterday. At least I read it yesterday. With Allie Wolf. I think Allie Wolf from Zonda is amazing. What did she have to say about new home construction?
Allie Wolf has an incredible pulse on the single family construction side of the market. And so we got a report out on Thursday of last week that that Wells Fargo put out their analysts that we're in a double dip housing recession, that mortgage rates running back up have pushed us into a double digit recession. You know, I looked at their numbers very closely. Essentially what they're saying is that residential construction activity isn't going to move up much more. It's going to, you know, fall a little bit next year, but kind of really be flat. So they're really calling for just not a recovery in housing. They're pretty much just saying, you know, maybe some resiliency, but kind of, you know, no recovery. And so them calling it double dip, you know, I'm a little like, because it's like we've had the huge free fall in activity, but it's like, how much more can we go down?
Yeah.
Obviously, the past few months have not been great for activity, no question. But I'm kind of looking out beyond that and kind of looking further into next year. And I really wanted to talk to Allie to see if she thinks we're back into a double dip housing recession.
Okay.
Because no question, the second half of last year, that was real housing recession. Activity was just falling so fast. But then into this year, it was kind of things kind of like leveled off a bit. And the builder side, net new orders went up. Now, as rates have continued to push higher into the second half of the year, we are seeing existing home sales move down a bit more. And that makes sense because there's also the lock-in effect that just keeps that supply from moving into the market. So I reached out to Allie, and here's what she said. And she said one key thing is, you know, taking a step back, this 2023 year continues to be a tale of two markets, one, the existing home market and resale, and then the new construction, which is experiencing a different reality. And the reality is that the transactions in existing can't make any improvement up because prices are so freaking high and affordability strained, and the sellers aren't giving much of affordability adjustment. And the fact that, you know, churn, these move up buyers and people who just don't want to sell their home and take on this mortgage rate, they're just not going in. And whereas builders, they got to keep volume going. They got to, you know, and so they're just taking some off profit to do the buy downs. And what she said is that, give me a second.
Yeah, the one thing is you pull that up that I'd love to hear from Allie, and I think you and I've talked about this over the last 6 months, is I think it's pretty clear that the big builders are going to look to dominate and crush the small and medium because they don't have the same financial flexibility. They don't have their own lending arm and all of that to do rate buy downs. I just wonder if the small and medium builders exiting, if the big ones are going to kind of fill that gap. I have no idea.
Yeah, well, it'll be interesting to see. You know, we have seen starts come down, but we've also seen completion stay relatively high because build cycles have came down. So builders are finally able to push this product out faster, which has kind of helped to make up for the drop in starts. It'll be interesting to kind of see how it plays out. And so back in the summer, she told me objectively the housing recession is over in the new home space. However, we're watching it closely to see if there's a double dip recession in housing, or if demographic supported demand is enough to withstand wider issues. And here's what she said. As of this week, I'm still on recession watch for the new home market. Last year, sales fell off a cliff in the new home market starting mid-year 2022. We are now seeing the cool down that started in the fourth quarter, but I'm not ready to say the new home market is back in recession. It takes more than 1 month to be a trend. So if you go through, she's saying that October is an inflection point for the new home market. It wasn't great. It wasn't good, but it's also mortgage rates have gotten so high and so high in the seasonally soft period. So it's like, okay, let's kind of see how things go from here. And what she said is no doubt there's still that east-west divide in home sales. Even with the slowdown, the eastern part of the U.S. continues to be stronger than the western side. And we're talking new construction. However, there are some markets in the Southeast, for example, that sentiment on the ground has turned negative. I attribute this to the fact that there wasn't a dramatic slowdown last year in the Southeast, so the cooling experience today feels abnormal. In many Western markets, housing demand was so weak last year in the second half that today feels better, all things considered. It's about perspective. Parts of the Southwest and Mountain West continue to underperform, including Colorado, Texas, Utah, and Arizona. The Midwest, historically an steady part of the country, has outperformed this year thanks to relative affordability, healthy labor markets. Nothing shocking there. And I thought that was very pragmatic of Ali to have this, okay, 1 month isn't a trend. Let's kind of wait and see. And sometimes, I think there's good things for making calls early. But then there's also sometimes it's like, okay, it looks like maybe it's going a little more that way. Let's kind of like wait and see how things roll out. I think that's a good place to be, especially versus last year when the shock and things were moving down quickly. Whereas to now it's like, okay, let's kind of see where we are. But everything feels like a grind. Everything feels like either a grind up, a grind fully sideways, or a grind down a little more. Is how I would describe a lot of the housing metrics.
Well, I think that's the housing market in general. I think a lot of folks were not ready. Like if you're in the industry, it's really a depression, right? We go from roughly 7 million total sales to 4.4 if you add new and existing together. That's tough. Existing home sales are going lower at 8%. It's tough. It's tough in the housing market.
The DOJ breathing down in air, and that stuff. We didn't even get to that, which I'll do a little more digging in for next week. But it feels like all of that legal stuff, it does really feel like it is some type of earthquake. And maybe it's, a small quake, or maybe it's the first tremor in something much bigger. But it does feel like it's the start of something. And it feels like the start of something where lawyers are going to make a lot of money.
It certainly does. And I'm always looking down the path. I have zero skin in the game either way, not an agent, not a broker, don't care. But I think the unintended consequences here is buyers could be hurt. Right. One of the things I think that may come out of this is buyers may have to pay their side of the commission or fee or whatever we call it in the future. And it's really going to hurt the first-time home buyers. I think one of the outcomes of this, when we look back in 3, 4, 5 years when all the legal mumbo jumbo is done, is first-time home buyers need more cash to close. And then if you think about VA buyers, veterans, they're supposed to be coming into a transaction with no money, 100% financing, all of that. They can't pay, or at least as currently written, as I understand it, they couldn't pay a broker side. So what do we do for VAs or veterans? I mean, this is an earthquake. The home buying process will fundamentally change in a couple of years, right? Once this goes to the Supreme Court.
And and I'm always where it's like there's always going to be unintended consequences to these types of things.
Agreed.
So it'll be interesting to kind of see how it plays out. And I can imagine a reality where a lot of change gets done, and then a lot of change happens and affects people personally, right? Like especially in the industry. but where the dial doesn't move in a considerable way for the consumer. Um, you know,
No.
I think there will probably be clever things that come out of it, to kind of continue to keep that money coming in. We'll see.
We'll see. We'll see. Well, Lance, you do an amazing job at Resi Club. I'm so glad you started it. Where can people find the free version? And if they want to get all the data and analytics and those 3 extra articles, tell us about the Pro Edition.
Yeah, follow me on Twitter at NewsLambert. I put a lot of the links to the articles, but if you want to go to the website and subscribe, ResiClubAnalytics.com, you'll find the website. Put in your email, and then after you put in your email, you can see the features for the paid, if you would choose to do so. And if you have any questions about Resi Club or what's offered in the paid, feel free to reach out to me, lanceclambert@gmail.com, or find me on Twitter, send me a DM or whatever.
Yep. Folks, do me a favor, reach out to him on Twitter or X. Tell him you saw him in one rental at a time. I'd love him to feel that his 30 minutes with us each week is worthwhile. Lance, I appreciate you. The audience loves you. Thank you so much.